Hello and welcome back to Dukascopy TV. Now, finding the right return and risk can be a tricky business in the investment world, and it can be made trickier in a financially turbulent environment. In the studio today with me is Egon Vorfeld, who's the managing partner at the Forum Finance Group. Egon, welcome to the studio.
Thank you, Thomas.
Most investors will know it's difficult to find the right combination of risk and return. Many investors will be paid virtually nothing to take on quite a bit of risk. How can investors improve on this?
It is true, Thomas, that we live in rather strange times now, where in the old days you could get a risk-free return by lending your money to the US government, or in fact some of the European governments, and get a reasonable return. Now we're living in a rather opposite world where you are getting a return-free risk, as some people might say. When you're lending your money to the US government now for 5, 10 or even longer, you are virtually paid nothing at all. We're talking 1, 2, 3%, which if you allow for inflation really means you're in negative interest rates, meaning that your purchasing power over time actually goes down rather than making some money on your capital. So this is a real concern, and we find that we have to go elsewhere to look for reasonable returns for the risks we're expected to assume when we lend our money and our clients' money to these institutions. So these would be sovereigns in the emerging markets and some of the lesser quality companies, but still very good quality companies in the US and in Europe, which are often referred to as the high yield companies.
Fixed income has, if we go to fixed income, it's had a good run in 2012. Where do you see opportunities going forward in 2013?
So currently, if you're lending money to the US government or European governments, you're paid next to nothing, up to 2-3%. And after inflation, you really end up with very little, and in some cases even negative interest rates. So we're looking more for companies who are considered high yield, but in fact have now got very strong balance sheets and reasonably good prospects as far as the economy is concerned. They're in a better position than they were 2-3 years ago. So these companies are still paying yields on their loans or interest on their loans to the lender of 5% or more. So those companies in Europe and in the US are of interest to us. And over and above that, we are looking more at the emerging markets where sovereign are still paying reasonable returns. And again, those countries are in fact in very good shape and are considered to be creditor nations rather than debtor nations. And I'm thinking of places like Abu Dhabi, Qatar, even Russia, and China, where state-owned companies or the state themselves are lending money at rates that are still attractive to us.
Egon, just focusing on the emerging markets and developed markets, I know you mentioned a second ago your interest in emerging markets. Can you just briefly explain to me the sort of key difference between emerging markets and being more sovereign and developed markets being corporate?
So our interests are now in just that, the sovereign side of the emerging markets and the corporate developed side, where it's the high yield companies, as they're called. These are companies that are not necessarily of the highest quality investment grade, but just below that, but still have very good balance sheets and reasonable visibility. And those companies are a lot stronger now than they were 3-4 years ago. So those are US and European companies, for instance, paying 5% plus interest on their loans, which obviously compares incredibly well to the sovereign in those countries. Whereas in the emerging markets, the sovereign are generally paying along those lines as well of 5% plus, where you are able to also benefit from a possible appreciation of their local currency. So in the local currency, that you will be getting a decent return and some upside on the currency versus euros or dollars perhaps. And there are some what I call supranational companies there that are in fact 75%, 100% owned by the sovereign, so an implicit guarantee really, which are also again paying much better interest rates on their loans. So those are really the areas that we're most interested.
And I mean, obviously, we're talking, especially if we're looking at emerging markets out of those two. You know, we're looking at BRICS, we're looking at Brazil, yes, India, Russia, China. We've seen strong inflows this year. Are we going to see the same kind of strength into 2013?
It is true that this year has been an extraordinarily good year, much better than most people would have expected, because a lot of people were investing in the local currency denominated debt of emerging countries. So that has been an incredibly successful investment in the last 12 to 18 months with huge inflows. Now we are a bit concerned, although we can see a little bit more upside there for 2013. We are somewhat concerned that some of these huge inflows could stop and even become outflows, and that could really turn things rather the wrong way. So we are carefully looking at that, and we expect those returns to be certainly much less than they were in the last 12 months.
Okay, thank you, Egon, for your points there on the emerging markets. Before you go, I've got to ask you the Dukascopy question, because like many people before you, we've had selections on the screen of real estate, equity, bonds, gold, cash, oil. We've had a lot choosing equity and, unsurprisingly, gold as well recently. If you had $1 million, what would you choose out of those?
Well, if I had to choose one, I would stick my neck out for gold right now. I think gold would be an incredibly good store of value going forward, and included in that I would say gold miners, which are particularly interesting equities right now. So I am cheating a little here, because with the current gold price, just where it is today, these companies are incredibly profitable and are starting to pay very decent dividends as well, which is all quite new. So we're quite bullish on gold and gold equities, but they haven't done very well recently, which is why they're so attractive right now. So it's really a mix of gold bullion as a store of value and inflation hedge, which will come to haunt us at some point with all that printing by the central banks around the world, and the miners.
Well, we'll have to wait and see on that one, Egon. Thank you very much for coming into the studio once again. That's all we've got time for on Dukascopy TV for the moment. Stay with us though, we'll continue to bring you updates and the latest interviews. But for now, and from all of us here at Dukascopy TV, goodbye.